Hello and welcome to the third in our series of webinars from Armanino around the Paycheck Protection Program. Today we're going to dive into the forgiveness application itself, which came out on Friday, May 15th, and try to explain the different details that are in this, basically unscrambling your mind. There's an awful lot of very confusing math in this, a lot of confusing rules. We're going to try to simplify that for you as best we can over the next 20 or 30 minutes. My name is John Sweisberger. I'm a partner in our business outsourcing services practice. I'm joined today by Jen McCabe, also a partner in our BOS practice, and Matt Petrosky, director in our tax practice. Together, we have been living the PPP program day in, day out for the last couple of months and are intimately familiar with every aspect of it, at least those pieces that have been released into the public. So today, Jen and Matt, let's dive in on a couple of basic areas of the forgiveness application. One around the things that are new to the application that nobody saw coming, and the other where we had a number of gray areas or areas of concern that got clarified with this release of the application on the 15th. So let's start with the first of those, which is the new surprises that have been dropped into the application. Jen, I'm going to kick the first one to you. Borrowers can now include expenses that have been accrued but not yet paid. What does that mean?
Yep, that means specifically that the SBA and the Treasury responded to all the consternation in the marketplace about how payroll periods were not aligning with the borrowing 8-week period. So what they've allowed us to do now is accrue expenses that have been incurred but not yet paid, providing we pay them in short order after the end of the 8-week period.
Got it. Okay, does that mean then that anything that I pay during the covered period, is, as long as it's an authorized use, it's good?
Well, in my opinion, yes. I would exclude only items that are paid that seem to be covered expenses that were really for something that you accrued relative to 2019. For example, if you paid your 2019 retirement contribution, if you think that that's going to be forgivable, I'd probably guess that it's not.
So let me play this out with an example. And Matt, jump in if I get any of this wrong. So let's say I'm a monthly payroll provider. And so I pay on the last day of every month. So I got my funds on April 26th. I've got a payroll coming up April 30th. I get to count that, right?
Right.
And then I've got another one on May 31st, and I can count that.
Right.
And then, but my June 30th payroll happens after my 8-week covered period, because that ends around, what, about the 22nd or so of June. So do I also then get to include June 1st to June 22nd?
You're a sneaky man, and yes, you could accrue that. And that's the example where you get the absolute most out of the program. The situation they were really thinking about was those people out there who have a lot of non-exempt or what we call hourly workers, and those people submit their timesheets and they get paid a week later, and the payroll always lags. And so they were really trying to make sure that that kind of payroll was included. But you're right, John, that's an example that you could now incorporate.
So there's a loophole in there that probably wasn't intended. Let's not be surprised if they close that loophole. Is that probably a safe bet?
They might do that.
Okay.
Especially for a monthly payer. I think your example is a good one for a monthly payer, or maybe a semi-monthly payer where you could get a little bit tricky.
You could maybe get 9 or 10 weeks in instead of just 8.
Yes.
Okay. All right. But then there's the weekly and biweekly payers. They get something new now, and that's this alternative covered period. Talk about that for a little bit, Jen.
So in your example, if a borrower got their money on April 26th and their next pay period begins on May 1st, they could actually delay the start date of their covered period to coincide with the next payroll schedule so that they could get the most out of the payroll. And this, again, works really well for people with a lot of non-exempt payroll or payroll that lags. A lot of times when you do payroll for a monthly or a semi-monthly person who's on salary, you get paid on a pay date for wages up to and including that day. But when you have a lot of hourly workers, and this really targets restaurants, retailers, it's better for you to wait and delay your loan start period, especially since you might be hiring people back more and more toward the end of your 8 weeks as the economy gets going. And so this will help them lay their payroll schedules down, and then at the end of that period, any timesheets they don't have yet, any overtime they don't have yet, they'll also be able to accrue it. So for them, this works really well.
Okay, Matt, I'm going to throw a curveball in on this one. So I'm a business that has a bunch of non-exempt hourly people as well as a bunch of salaried exempt people. I pay my hourly people every week, and I pay my salaried people semi-monthly on the 15th and 31st. Mm-hmm. Which one of these do I get to choose? Or can I choose either one? Both?
Well, I think for in this instance, you could potentially choose both. I mean, you have the two separate payrolls and kind of tracking it both ways.
Okay. So, but I would guess that if I'm semi-monthly, I have to use the 8-week covered period.
Right.
And I can't use this alternative thing, right?
Correct.
Got it. Okay. Okay. Fun surprises. All right. Let's go to the next one, which is not so much relevant from a calculation standpoint. It just makes it lots of fun to add a bunch of data. And that's this. Don't just name your employees. Give us their social security numbers too. Matt, what do we get out of doing this?
Well, I think the big takeaway is there's some worksheets attached to the actual application, some that need to be submitted, some that do not, and essentially you need to have them together in the event of an audit. But what it does do is it really lets you know that you have to go individual by individual, and including that employee identifier. What is their cash compensation? What are they, and we'll get to the average FTE, but what is their number, whether it's exactly 1.0, whether it's something less, and then any salary or hourly wage reduction. So I think the big takeaway is there's a lot of information that you do have to pull together on an employee by employee basis and keep it ready in the event that the SBA requires that you provide it to them.
Okay. And are they going to be able to come back and audit? I don't know what they're going to do with that social security information. Do we have any insights?
No, we really don't. As you think about it, the question comes up, well, are they going to double check that each individual employee is on your payroll? Maybe. But at the same time, if they're only looking at the last 4, it's not like they can cross-check between multiple employers to make sure that multiple organizations aren't taking the same employee.
Okay, well, there it is. It's a new surprise. And another one is on the application itself. Now you not only have to put in all the usual demographic information, date of your loan, amount of your loan, all of the borrower name and contact information, but also the number of employees that you had when you applied for the loan and when you apply for forgiveness.
Right. No one knows why. There's nothing, it's not defined, employee is not defined. If we think back to the application itself, it was head count. The number was head count, and the head count was what determined whether you were at that 500 threshold for eligibility. But as we know, the head count was not the same as what we think of as the FTEs, and as defined here in the application. It was full-time, part-time, or other, so it could be a different number. But it seems to be that they're looking for what is that number that you put on your application, and then what are the number of employees at the time of forgiveness. And I don't know if we can assume that this is the same definition as headcount. It's not otherwise defined
Yeah,
in
but
the application.
wasn't headcount like average 2019 or something like that? Or
Correct.
last 12 months?
Correct.
Okay, well, that's different
So
than April 3rd or whenever I
right.
applied.
It's whether the employees at the time of the application we would think that they're expecting it to match up to the headcount, but that's not necessarily clear either. And then employees at the time of loan forgiveness, whether it's just the timestamp.
Right. I bet you that they really want to know, they probably should clarify this. They either want to have this information for census purposes to see if generally people had a certain number of employees when they applied and they had less by the time they applied for forgiveness, or they really meant to say, what did you say when you applied that you had, which is the head count number, John, and what's the head count you have now, so that they have the comparative data. But it's not very clear what number they're asking for, and if they told us what they were using it for, we could probably figure it out.
Because it doesn't factor into any calculation, right?
Nope.
No.
Well, forgive me if I look like the gentleman here on the right in this picture, because I'm just a little baffled by that.
You do,
All right.
but he's younger.
Well, and I didn't need to write 28 minus 3 equals 25 on the board either. I could pretty much do that one in my head. But we digress. Let's move on into a bunch of areas that have been the source of so many questions over the last several weeks. These gray areas of interpretation, many of which got clarified. All right. So let's start with this, Matt. I'm going to throw this one your way.
Mm-hmm.
The 75% rule. So much has been written and talked about this 75% rule and what's the denominator and is it a bright line and everything else. Walk us through this.
So really there were some big questions about how we do sort of what I would call the SBA math. How do I get from the 2.5 months to 8 weeks and get to 75% when 100% of my payroll on that 2.5 months, if I do the math, it's 73.7%. But really what it is not 75% of your loan amount. It's you need to make sure that 75% of you're sort of capped at 75% of your forgiveness amount has to be on payroll cost. So I think it makes it easier for a lot of borrowers who are really concerned about hitting that 75% of their total loan amount, especially if they maybe had any kind of reduction in force. It would be hard to maintain that payroll. And also, I think some organizations were concerned, well, maybe I give money back to hit the 75%. But I think what we have here is really defined that you're kind of taking what are my payroll costs, and this gets to the calculation that they say it's that divided by 75% will get us the maximum that we can get in terms of loan forgiveness.
Okay, let me say that again, because we get so many questions about this in the last couple days. So Matt, if you spend $500,000 on payroll, despite whatever your loan is, if your loan's $1 million, your loan's $1.5 million, and you spend $500,000 on payroll, you divide that number by 0.75 and you get $666,000. That's your maximum forgivable amount, and 75% of 666 is 500 grand, and that's the maximum forgivable, which means you have $166,000 to spend on rent, utilities, and other stuff, right?
Correct.
Okay, got it.
Okay, we'll probably get that question still a whole bunch more times, but it's good that we've at least got some clarity on that. The one other thing I'd add into that is, while the forgiveness application is strictly focused on the forgiveness calculations and the covered periods and all that, there is this whole component of leftover money that turns into a 1% 2-year loan. And the guidance that has been given by Treasury in their interim final rule notices is that 75% of the loan proceeds also need to be spent on payroll costs. So that would suggest that in your example, Jen, that amount that either didn't get included in forgiveness or didn't get spent. So all that amount over $666,000 that was left over, that's now a loan, that still needs to be spent 3/4 on payroll costs. Now, what's unclear entirely, because there's been nothing written about this from the government, is and how are they going to check? Is that going to be a requirement of the banks to audit? Are you as a borrower going to need to produce some sort of documentation or certification as you do loan repayments? Completely untouched so far. So we don't know, but there has been at least that rule written in the IFRNs that 75% of both forgiveness amount and amount borrowed needs to go into payroll cost. But for forgiveness calculation purposes, we can just ignore that last part. Just want to make sure everybody's clear. Okay. Second thing, FTEs. Finally, we have a definition, sort of. Matt.
Yes. So I know there was some question about what an FTE is. How will they be defining it? I think there's some areas of payroll and benefits that 30-hour work week is defined as full-time. Happy that they've gone with the standard 40-hour work week. So you have a couple options. The first is calculate each individual employee and using 40 hours as a baseline. So the maximum amount that each person would count as 1.0. So if they're average 40 hours a week or more, then essentially they count as 1.0. And if they are less, you round to the nearest tenth. You do have the option, instead of rounding to the nearest tenth, is anyone who is part-time, giving them 0.5. And this may seem like one might be more advantageous than the other, but really what you have to do is go back through the two different periods. Is your covered period, and then whichever other period you are using for your calculation to determine which way would give you the most beneficial result. And it may not necessarily be apparent on its face. So I think you do have to go through the calculations.
Right, and logic would say if you are an organization with 5 full-time people and 30 interns that work 15 hours, then you'd want to go this route. But if you had a bunch of people who you had working just 30 hours, 32 hours, so they got benefits, you'd want to go the other way.
But I do think you need to compare it to the prior period. So it depends if, let's say, in the current period, you have a lot of people who are 0.1, but maybe in the prior period they were at 0.7. I think you just want to make sure the math works. So it would seem that one would be more beneficial than the other, but I really think you just have to look at how things work out in each of those periods to confirm.
That's a really good point, because if you converted your staff to a bunch of part-timers post-COVID, and pre-COVID you had a bunch of full-timers, it's a really important calculation to go through.
That in that instance where you had full-time people that now they're at 0.2, you definitely would want to use the option and round them up to 0.5.
I think I'm going to change the picture back to the guy scratching his head. This is making my head hurt. So in addition, if I had a bunch of people that were hourly and I was paying them overtime, I can't just add up the hours and divide by 40 to get my FTEs, because I've got to pull those overtime hours out of the equation, right?
Right, and that's why you have to look individual by individual, because remember, even if they work 50 hours, they only count as 1.0. So they count as one full-time employee.
I can't take 3 50-hour people and add up 150 divided by 40 and get 3 3/4. I actually can only get 3 out of that, right?
Right, and that's going to be a hard thing for people who are running restaurants, for example, and they're down to just the family, and the family is working overtime instead of hiring someone. That is where they could be penalized for not rehiring someone back. And in those cases, those folks are not accepting the job offers to come back because they're really happy on unemployment. And so in those cases, I have an example just like this, where there are 3 family members, they're all working overtime. And so I've asked them to get the declination of the offer of rehire in writing so that they don't get penalized for the FTE. So that's where it would really apply in a very tangible way.
Got it. Okay. Well, gee, I thought that was going to be a simple one. It's not. Okay. Person by person we go. Okay. The next area that got clarified was really important to me because I had explained this to an awful lot of people over the last several weeks that until we got clarifying guidance, the language that was in the act itself around the salary reduction calculation was a almost diabolical gotcha waiting to happen. And that was the absence of the word average. So the way it was written was you compared the total compensation of each employee for the 8-week covered period versus the total compensation each employee earned in the first quarter of 2020. Well, that's comparing 8 weeks against 13 weeks. And if that total came in less than 75%, you had to reduce dollar for dollar on each employee. Fortunately, they dropped the word average in. So now you're comparing the average salary and wage that each employee had in the covered period with their average pay during the first quarter. And if there was a reduction of more than 25%, again, do this for each employee, then you calculate the dollars over and above that 25% reduction. So if you cut their pay by 40%, we'll just say from $100 to $60, then that's more than the cut to 75, which you'd be allowed with a 25% reduction. So you'd have to take the $15 difference between 75 and 60, and that would come off of your preliminary forgiveness amount. So that's a relief that they did that, and I think saved one heck of a lot of surprises for an awful lot of people. And the other thing they did, Jen, I think this is a very good one as well for borrowers, is defining the order of events and changing it from what was in the act, the way it was written in the act itself.
Correct. So in the example you just listed, you would do your salary reduction first, and that's a dollar for dollar reduction. So if you reduce someone's salary by more than 25%, I should say, then you have to reduce dollar for dollar, and that's going against your forgiveness calculation. But then after that, you apply the FTE quotient, the reduction. So if you reduce your staff by 10%, you apply that 10% reduction after you've done a subtraction. It is exactly opposite to how it was written in the act.
And that's definitely to the borrower's benefit because it reduces the percentage of the dollars against which that percent gets applied, which is a potentially valuable thing, given that all this turns into money you owe back to the lender at that point.
Right.
Okay, and then they got into finally some guidance around documentation. And this may have some impact on certainly every borrower, but every bank as well.
Yes. So we've known for a while that they want to see documentation for the amounts paid. Well, now they want documentation for the amounts accrued. So if you have an expense that you incurred but haven't quite paid, you need to have a work paper showing that accrual, and then you also need to show that you paid it shortly after the end of the 8-week period. And then when it comes to payroll, that's the big piece here. So they're saying they want tax returns that support the payroll filing, but it is completely unlikely, in fact, it's impossible for the 941, for example, to support your 8-week covered period because a 941 covers a quarter. If your 941 has to be provided for both second and third quarter because your loan 8 weeks sloughs over into July, it really won't tie. But I would suggest that most borrowers want to provide the 941 for the second quarter, which should be available in the first couple weeks of July, and wait until they have that. Just check the box, just to say they did it. And then the 941 should be documented, supported by actual payroll journals or reports out of your payroll system. I would not suggest that this comes out of your accounting system per se. I think you do want to show payroll journals. Those payroll journals go person by person, and at the end of most payroll reports and journals, it'll have at the bottom the hours per that payroll period too, which will tie right back into the FTE that you're providing. So payroll journals are going to be your friend. That's what you want to really focus on documenting. And if you've got your loan and you're listening to this, right, starting now, put it aside. Put these payroll journals aside. They're your biggest tool.
And I think the other thing that people are going to need to keep in mind is there is the safe harbor around restoring pay and or employment by June 30th to your February 15th levels. You're
Right.
you're going to definitely want to take advantage of that, because if you are able to do both of those things, it takes out those reduction factors, which are very significant. And so that's probably going to be something else that will suggest, even if your 8-week covered period ends the 15th of June, you may want to hold off until you can document your employee count and salary level as of June 30th.
Right.
So you can get that safe harbor.
Yep.
Okay, well, that certainly helps an awful lot of the big things that people have been asking us about. The next thing we want to do is kind of walk through some math and give you a couple of examples, because it's one thing to talk about it, it's another to see numbers. So let's walk through fictional ABC company first. Here's a company that laid off 20% of their staff on March 15th, right at the beginning of the shelter in place orders and things like that. And they said, we just can't keep everybody going here. But based on their 2019 payroll and everything, they qualified for $1 million loan, and that's what they got. But because they reduced their staff by 20% and cut the remaining staff back by a lot in their salaries and wages, they were really only able to spend about $600,000 of that $1 million. Now, to their credit, they did spend 75% of that on payroll, as you see here, $450,000. But they had this significant salary and wage reduction that pulls $300,000 out of their for gross forgiveness amount, as well as, because they reduced staff by 20%, they have to do this reduction quotient on FTEs. And so what you see here as a modified forgiveness total isn't the $600,000 they started with. It's actually $240,000. How do we get there? Well, you took that salary and wage reduction factor dollar for dollar out of the gross forgiveness amount. So 600K minus 300K. And then we applied this FTE reduction quotient, 0.8, to that $300,000 and ended up with $240,000. Even though they spent $600,000 on forgivable spend and stayed by the rule of 75% on payroll. The other way to look at it is this payroll cost divided by 0.75 that Jen was talking about earlier, that we've had already several questions about. Why is that a divide and not a multiply? What we're trying to do here is back into the amount of forgiveness, payroll being one portion of it. So if in the case of somebody coming in less than 75% on payroll, this becomes a relevant number for the purposes of figuring out forgiveness. In our case here with ABC Company, because they hit 75%, well, you do the math, 450 divided by 0.75 gets you back to that 600,000. So 600,000 is a gross number, but because of the modified number is lower, you have to take the smaller of the numbers. Therefore, you don't get the 600. You only get 240 forgiven, and $760,000 is what's remaining on your loan at 1% interest for 2 years.
So John,
So,
give me a minute here. So I
okay.
get the lesser of three numbers on this page. I get the lesser of the loan, which is $1 million, or 600,000, or 240,000, correct?
That is exactly correct. And that 600 is not because it's the amount spent. It's the 600 that you see on that payroll cost over 0.75 line.
Got it. And the $300,000 salary reduction is what?
Okay, that is looking at each employee and comparing their average salary during the covered period with their average salary during the first quarter. And because I did both a layoff and a rollback in people's salaries to be able to get through this period, I had a pretty significant number there. Think about it this way. In order to get $1 million loan amount, your average payroll would have been around $400,000 a month because you took 2.5 times your monthly payroll to figure your loan amount, right? In this case, we only spent $450 total in the 8 weeks. So we cut back quite a bit, both in terms of our 20% layoff, and the remaining 80% of the people had their salaries cut quite a bit in order to only come in at $450K in payroll cost.
So you slashed it, yeah. So you slashed their wages by more than 25% in lots of cases.
Yep, exactly.
Okay, got it.
Okay, so you can see here how those two reduction factors, both on salaries and wages and on your FTE count, really has an impact to the amount that ultimately gets forgiven, even though they basically played by the rules. Okay, now let's contrast that with XYZ Company. Now, XYZ Company had a bigger layoff, but did it before the look-back period. Remember, the look-back period is your basis as of February 15th, 2020. What was your FTE count and what were your salary levels at that point? Well, they actually did a much larger layoff, but did it before that look-back period. So in this same case, $1 million loan, spent $600,000, but they actually only spent $400 on payroll costs, so they didn't hit that 75% bright line. Okay, but because they didn't make any further layoffs after February 15th, and they didn't do any salary reductions, they actually still have a $600,000 modified forgiveness total because all this happened before the February 15th period. So now we have to look at that payroll cost divided by 0.75 line. And because they spent $400,000 on payroll, divided by 0.75, you get to $533,333. That being the smaller of the three numbers, 533, 600, or $1 million, means that their net forgiveness amount is $533,000. Therefore, the amount that they owe on their loan is the remainder, $466,667. Okay, so this is two examples of companies who had the same loan amount, spent the same on authorized uses. One hit the 75% number, the other didn't, but based on the timing of layoffs, you can see how these reduction factors have a huge impact on the resulting forgiveness and the remainder that's remaining amount that's owed on the loan. So we thought it would be helpful for everybody to kind of see those numbers in action as it works and really help you to make sure that you develop the right best strategies for how you spend the money that you've got, handle the forgiveness in the way that's going to be best for your business, and keep in very much the front of your mind that safe harbor rule around June 30th as it relates to both of those two big reduction factors.
Right. And before we have people panicking, I mean, this really makes it clear that keeping your staff and keeping your wages at certain levels is really beneficial in terms of getting you higher forgiveness amounts. But If it just still doesn't make sense for you, what is the loan bottom line terms at the end here? On my amount owed on my loan, I don't have a payment due for 6 months at least, right?
Correct.
And
Well, by the end of this, more like 3 or 4, but yeah.
Yep. And then my rate is 1%, and my term is 2 years. And those things are actually being discussed in upcoming legislation. They're talking about extending it more than 2 years, for example. So if anybody is listening and panicking, please don't. There's still good news.
But I think it's also a good reminder to plan ahead.
Yes.
It's run the scenarios, run it now that you have the money or have only had it for a brief period of time, because ultimately the forgiveness impact could be significant depending on which way you go. And I think you want to have all of the information to determine, if we add people back, if we try to take advantage of the safe harbor to not have the various reductions, how will that impact us versus maybe we do want to save the amount as a loan.
And as with everything we've been talking about in this webinar series, it's all subject to change. We fully expect there will be more guidance that will come out in the form of FAQs or new IFRNs. So please stand by for all of those changes, and as they come through, believe us, we are monitoring it hour by hour, and as things evolve, we will continue to do these webinars so that you can be as informed as possible as a borrower of these PPP loans. If you'd like to get additional help because your brain has exploded from all this complicated math, A, we totally understand it, and B, we're here to help. So we can do a couple of things for you. If you'd like, to Matt's point around having that plan, to consult on how you use those funds and help you develop various forgiveness strategies based on modeling your current and expected spend, we're happy to do that. In addition, if you would like to say, I'm so far down the road, that's pretty much in place, but man, I do not want to try to go through the math on this application and all the details of every employee I've got to load in. Can you just do that for me? Our answer is yes. And you can see here the pricing based on the size of the loan. For more information and all the details around this, you can visit our website at learn.armaninollp.com/SBA. And as well, for more general information about anything related to the COVID-19 crisis, we have our resource center available on the armaninollp.com main webpage. One click and you can access the resource center that's got close to 200 articles around these 5 different categories that you see, including a whole bunch of things around questions that people have right now on the going back to work problem. And we'll do a whole webinar around that here shortly to help you understand all the different challenges that go into reopening for business. So stand by for that. That should be coming here shortly. But in the meantime, Jen, thank you very much. Matt, thank you very much for giving us your time today to help answer all these questions. We hope that at least unscrambles things a little bit for you, and stay tuned for the next in our webinar series on the PPP program.
Thanks, everybody.
Thank you.